So this slide really is highlighting our rating scale and what each of these rating categories really mean in terms of the ability of the company to repay its debt obligations in a timely manner, as well as what really is the credit risk which is underlying with the company. So the table on the left side of the slide actually indicates the rating deficiency, the definition for all the rating categories, starting from the highest rating of AAA to the lowest rating of D. What you see on the right side is a blue arrow, which indicates the degree of safety regarding the timely debt repayment. So higher the rating, the greater is the ability of the company to service its debt repayments in a timely manner, and vice versa. And the orange arrow on the extreme side indicates the credit risk of the company. So higher the rating, the lower is the credit risk associated with it, and vice versa. Now we can explain this through a simple example. Let's say there's a company which is rated highest at AAA. What this really would mean is that this company has the highest degree of safety regarding the timely debt repayments, and it has the lowest credit risk associated with it. And if there's a company, let's say, which is rated at a much lower level in the speculative grade, let's say for the sake of discussion, it's rated at a B level, we would say that the risk of default in this company is high, as the safety or the ability to repay debt on a timely basis is low. So gradually, as you go down the rating scale, the credit risk would increase and the ability of the company to service its debt on a timely manner would reduce. I'd like to go on to the slide in a little slower pace because I want you to digest. There's a lot of data in here. So this slide really highlights the default rates of various rating agencies across rating categories over a time period of about 10 years. I'd like you to observe the chart on the top left side of the slide. This really is the default rates of S&P. It's the cumulative default rates over a 10-year horizon. For example, if you see the blue box in this chart, there is a 0.75% chance for a triple B rated entity to default in the first 3 years. Now, the interesting trend to observe is that the variation in default rates, and you can refer to the dotted red box that we have on the left side of this chart, is actually very minimal in the high safety ratings ranging from AAA to AA to A. So you see that up until the 6th year of the rating, if an entity is rated at AAA, AA, and A level, the variation is only between 0.45 to 0.6%. However, this percentage of default progressively increases, and rightly so, because it really reflects the credit risk in the company as you go down into the rating scale from a triple B to a double B to a single B. And the chart on the right side of the slide, at the top right, indicates the cumulative default rates of corporates which are rated by CRISIL Ratings in Thailand. This is a domestic rating agency. And just want to highlight here that there are some default rates which would appear out of line and very high. That's simply because the sample size of the data is small. So you can see that the default rates at double B and single B levels are extremely high, but that's simply because of the number of cases being much lesser. At the end, there is a default chart that you see on the left bottom of the slide, which is really the cumulative default rates of CRISIL rated entities over a 10-year horizon. Now, CRISIL is India's largest rating agency, and you really can see the same trend of significantly higher default rates as you go down the rating scale from investment to non-investment grade here too. The default rates of TRIS rating and CRISIL being on domestic scale actually cannot be directly compared to S&P's default rates because they are on a global scale. The conclusion that one could make out of this data is that the domestic rating scale offers greater flexibility to differentiate companies on the as compared to the global scale. Because if that company was rated on a global scale, it would be restricted to the bottom of the rating spectrum with relatively higher default rates. And if it's rated by an entity which offers a domestic rating scale, it could have the opportunity to actually get reflected based on the credit risk on that domestic scale.
Thank you, Prachi.